Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of the Institute of Chartered Accountants of India, I welcome you all in today's 69th CP program organized by AASP of ICL. Today we are organizing a webinar on a very important topic, that is the going concern. So topic of today's webinar is evaluation of going concern during audit. And in order to tackle this technical session, we are having with us very eminent speaker and learned speaker, CA Prachi Kadamji. I welcome on behalf of AASP of ICL. Welcome to you, ma'am. It is my proud privilege to share with you the brief profile of Prachi Kadam, madam. Prachi Kadam is a senior manager at SRBC and Company LLP and has an experience of more than 17 years in the field of auditing. She specializes in the financial statement auditing and accounting. Accounting and auditing are her very eminent interest subjects. She has led the audit of large manufacturing companies that include poultry, pharma, and construction sector. She and the list is very vast. So, on ICI, I extend my heartiest thanks towards Prachi ma'am for acceding to our request on a very short notice to deliberate on this very important topic. And I request Prachi ma'am to please deliberate on the topic.
Yeah. Uh, Thank you for the introduction, and also thank you for the providing me with an opportunity to present a session on going concern today. I'm sure that all of us in our professional life would have definitely come across the concept of going concern. We are also aware that the concept of going concern is of fundamental importance and an integral part underlying the preparation and the presentation of the financial statements. We have also witnessed the challenges imposed by the pandemics like COVID-19, followed by the national wars between the Russia and Ukraine, and how it has literally reduced the life cycle of the corporates and the entities, and has also put a question on the existence and the survival of these entities. Nevertheless, during economic prosperity, while the concept of going concern may not impose the challenges, but the critical situations which is imposed by the external factors may bring into question the entity's ability to continue as a going concern. And hence, in today's session, we are going to discuss the going concern concept. We are going to dissect the going concern concept. We are going to understand how the assessment of going concern is carried out, how does the evaluation happens, how the auditor has to reach the conclusion. We will also add certain case studies based on the practical life situation just to understand the concept at a more granular level. Let's move on to understanding the concept of going concern. When put into the words, understanding the concept of going concern is fairly simple. It signifies the ability of the entity to continue the operations for the foreseeable future. What does it mean by ability to continue the operations for the foreseeable future? Firstly, the entity is able to operate in the normal course of business, which enables the entity to realize the assets and discharge the liabilities as and when they fall due for its payment. It is very essential for the entity to continue in operations for a foreseeable future. The foreseeable future is defined to be a period of 12 months from the date of the financial statements. Now, what is foreseeable future has been defined differently under different gaps. In an Indian scenario, the foreseeable future happens to commence from the reporting date of the financial statement. So if we follow 1st April to 31st March as a financial year, a period of 12 months would start from 31st March. In a different territory, let's say in under US GAAP, the period of foreseeable future commences from the date when the financial statements are issued to the public at large. Nevertheless, the assessment will need to be done for a foreseeable future. Having put it so simplistically, now what does it make the going concern as a concept, as an assumption underlying the financial statement difficult for its evaluation or assessment? There may be certain events or conditions or situations that make the corporates or the entities difficult to operate. There could be a scenario that may impose the liquidity pressures in terms of the margins on the organization, due to which the entity may not be able to continue as a going concern, meets its liabilities as and when they fall due. These factors, widely termed as the material uncertainty. At a times, these material uncertainties may be of such a magnitude that it may have a potential impact on the continuance of the entity in a near future. Just to illustrate simplistically, a pending legal proceeding against the entity, which may result into a heavy claim where the results go unfavorable to the company may not be able to satisfy the heavy cash outflows resulting out of these legal proceedings, which may signify that the company would have a distress scenario, a distressed liquidity position, and may not be able to meet its liabilities. Let us have one hypothetical example that would illustrate what is a going concern and what are the material uncertainties that may doubt or that may question the going concern status of a company. So we have two companies on the screen, company A and company B. Let's have a look at company A's financial position and company B's financial position for a moment. Okay. As we all can gauge, judge, and assess, the company A seems to be in a healthier financial position with positive net worth, positive working capital, current asset exceeding current liability, a reasonable, sustainable current ratio. As against that, if we have a look at company B's financial position, it seems to be not at all in a healthy financial position. The company has negative net worth, wherein the negative profits have almost eroded the company's equity. The company's current liability exceeds the company's current asset position, resulting into negative working capital. Based on this simplistic scenario, it is very easy to conclude that historically, the company B, based on its financial position, may have hardship in the near future to continue as a going concern. Whereas company A, based on the historical results, we may conclude that it may not have or may not necessarily have the financial difficulties in meeting the future obligations, and therefore there is no question as to the going concern assumption being challenged as far as company A is concerned. However, going concern is not what about we are able to see on the screen. It is much more beyond that. Let's continue with an example of company A to see how the going concern concept gets affected at a granular level. Having retained the same financial position, company A incurs a heavy penalty in a lawsuit which almost amounts to 150 crores. Now, when we have a look at the financial position of company A has a mere cash and bank balance of 30 crores. It may be able to realize some amount from the working capital, however, which will again need to be deployed into the business activity. The company has good amount of net worth. However, when considered the cash outflows of penalty, there is a possibility that the net worth may become negligible or it may get completely eroded. So, in this situation, we can reasonably conclude that due to the event that has taken place after the balance sheet date, that is after 31st March and before 12 months, which is expected to be a foreseeable future, it cast a significant doubt on the company's ability to continue as a going concern. Thus, in nutshell, or to summarize, the going concern is not a perception, it is not an assumption. and therefore it needs to be evaluated carefully at a granular level and needs to be concluded accordingly. Let's have a look at the adverse condition or the events that may cast the significant doubt on the going concern ability or going concern assumption of the corporates. Some of these have been enlisted on the screen. This is not the exhaustive list. There may be many more situations beyond these pointers that may point towards the challenging situations of the going concern assumption. The more common could be the adverse net current position, negative cash flows, adverse key financial ratios, deterioration in the value of the assets of the entity. There could be loss of major market key customers. There could be plans of the management to liquidate the entity or cease the operations. There could be non-compliance with the statutory requirements, which could result into heavy cash outflow. Pending legal proceedings, as we have seen in our example, the changes in the rules, regulations may also adversely affect the existence of the entity. As an auditor, we need to be careful and exercise our skepticism as in when we hurdle across any of these matters that may cast a significant doubt on the going concern assumption of the entity. While we have put the going concern understanding so simplistically, then why it is being always said that it is very difficult to assess the going concern assumption? The going concern analysis happens to be subjective. It calls for a lot of judgment. I have tried to list down certain reasons behind it. First of all, the going concern concept, because it involves the judgment and a prediction or a reasonable judgment as to the prediction of the future events, there will always be an element of inherent uncertainty to do these predictions or to do these judgments precisely and reasonably. The another important factor that contributes towards the complexities of the assessment is the forward-looking period. The foreseeable future, which is 12 months from the balance sheet date, is widely or in a common parlance known as a forward-looking period. The more the length of the forward-looking period, or as and when the forward-looking period gets extended as a result of the auditor's assessment or management's assessment, the less would be the certainty of the outcome or the prediction of the uncertain events. The assessment may become complex during close call situations. Close call situations are those scenarios where the management, having assessed the challenges around going concern assumption, brings in certain plans or brings in certain support that may either partially or completely eliminate or elevate the going concern assumption. Now, the auditor literally has to step into the shoes of the management to understand how these plans would turn or would make the going concern assumption possible. It would require challenging the assumptions made by the management. It would call for assessing the probability of the plans or the plans getting implemented by the management, so forth and so on. Lastly, the amount of information available to conduct the going concern analysis, the timeliness of the information available, rapidly increasing number, complexities of the business transaction, technology-enabled transaction, the speed with which these transactions takes place may completely change the dynamics of the assessment together. All these factors, either individually or considered in aggregate, make the going concern assessment tricky, complex, and call for the additional audit procedures and exercise of the significant judgments. Having understood the going concern concept, let us also understand who shares what all responsibilities towards the assessment of going concern. So when it comes to the responsibility, various statutory authorities in various territories impose mandatorily or require the going concern assessment to be done by the management. Even in Indian scenario under Companies Act, Section 134 that deals with director's responsibility statement requires the management to ensure and ascertain, assess that the financial statements have been prepared on the basis of going concern assumption. SEBI Regulations 18(3) also requires and also has a similar expectations from the audit committee. Given the scenario of the fast-moving world with the fast technology, the stakeholders generally call for the early warning information. With the reduced frequency of the issuance of the audit report, wherein the auditors would definitely highlight the going concern assessment, going concern judgment, there has always been the ask for the more information, and therefore it is first and the foremost responsibility of the management to assess, analyze, evaluate, and conclude the fundamental characteristics of the financial statements, that is the going concern assumption. The auditor's responsibility is to evaluate the assessment made by the management and ensure the appropriate reporting repercussions in the audit report. In a scenario where the management has not undertaken the going concern study, the auditor has a right to ask the management to complete the assessment before the audit reports are issued or during the course of the audit. Having understood management's responsibilities, the standards on auditing also cast the onerous responsibilities on the auditor to conduct the going concern assessment. SA 315 that deals with identifying and assessing the risk of material misstatement requires the auditor to conduct certain specific assessments before the audit or at the time of planning the audit. Going concern assessment is one of the risk assessment procedure that the auditor is required to conduct. This certainly helps the auditor to plan the audit and also allows timely discussions to be held with the management. During the course of the audits as well, the auditor is required to remain cautious about the audit evidences that the audit team is collecting. Some of the audit evidences may point out towards the events or condition that may have a direct correlation with the going concern assessment, and hence it would certainly impact the determination of the nature, timing, and extent of the audit procedures. Needless to say, the subsequent event assessment would also cover the going concern related aspects. Let us have a look at the case study as to how the going concern related assessment, risk assessment, and the analysis could be imposed during the course of planning the audit. Let's have a look at the case study for a moment. Coming back to the case study, the auditors of XYZ Private Limited, during planning meeting with the management of XYZ, were given to understand that one of the prime lenders of XYZ has terminated the financial support. The termination took place as XYZ was not able to maintain the current ratio as envisaged in the loan covenant. The deterioration of the current ratio is mainly due to reduction in demand of the profitable products. Analyze the implication of this piece of information over the audit planning. I'm sure while most of you would have analyzed and understood the implication of this piece of information, let us see what it actually culminates. Under section 315, as the auditor, we are required to do the specific assessment of the going concern. The termination of the financial support will need to be analyzed and evaluated specifically to see whether it is putting the organization or putting XYZ into the financial difficulty. Declining demand for the product, while it affects the current ratio, while it puts the pressure of margin onto the company, it would also highlight the important considerations with respect to the inventory valuation. It is quite possible that the declining demand for the product may force the organization to state the inventory at its net realizable value. So the auditor, having analyzed the implications of this piece of information, will now need to design the audit program in response to the risk. And as a part of the audit program, the auditors would now need to evaluate the going concern assumption, hold the discussions with the management, understand what alternate plans do the management has and what is management's conclusion. And similarly, this specific consideration with respect to the inventory would need to be necessarily embedded into the inventory related audit program. Taking forward the similar case study, now let's see what happens when the termination of the loan facility or the extension of the loan facility gets identified during the course of the audit. Let's have a look at the case study for a moment. So, considering the same scenario, except that the auditors of XYZ Private Limited, instead of planning meeting, the auditors identify various correspondences with the prime lender seeking extension towards the loan repayment period during the course of audit. Now, what would be the auditor's responsibility in this scenario? SA 570 requires the auditor to remain alert, exercise the skepticism throughout the period of audit, and this additional piece of information which the auditor becomes aware during the course of the auditor immediately need to correlate with the going concern assumption, and under SA 330 need to design the additional audit procedure to understand and evaluate whether going concern assumption happens to be appropriate in a given case, and if not, then what would be the reporting implications. Next in a row comes the period of assessment. Certainly the period of assessment, as we discussed, is a look forward period of 12 months. It gets extended beyond even the period that would reasonably cover or that would reasonably be termed as a subsequent event period. Ind AS 1 and AS 1 also specifically requires the period of assessment to be that of 12 months, but it may not necessarily be restricted to a period of 12 months. If the management covers the lesser period of assessment, the management in all rights ask the auditor in all respect ask the management to extend the analysis to cover the desired period. Now, what happens or what situations compel the auditor or management to extend the period, look forward period, or a foreseeable future? During the process of the audit or being the first-hand possessor of the information, the auditor or the management may be naturally aware about certain events or schedules or otherwise certain conditions that are going to soon occur beyond the period of assessment. In this case, the auditor and the management may decide to extend the period of assessment. This could be the situations where the prime lender's financing facility are getting expired immediately after a foreseeable future. In such a case, the period of inquiry can be extended. However, the auditor's responsibilities remain restricted to making inquiries of the management. The auditor is under no obligation to perform a complete suit or a complete audit program or a detailed audit program that may consist of the additional audit procedures. Let's move on to the next slide, wherein we are going to see how to perform the assessment. Coming back to the assessment once again, in case where the assessment is not done by the management, the auditor is never required to rectify the lack of analysis by the management. Lack of analysis by the management may find an appropriate repercussion as far as the audit report is concerned. There is no specific method or there is no typical methodology or a calculation that is prescribed as far as the assessment of going concern takes place. To our knowledge, the steps that I have enlisted on the screen could be a simplistic approach as to how to perform the assessment. So as a step one, the entity may identify its current financial condition. How much excess funds do the entity has? How much liquid funds the entity has? As a step two, the entity shall analyze what are its future obligations, whether there exist any contractual agreements in terms of lease or whether there exist any further commitment that entity needs to honor. Entity then identify the funds which it needs to maintain to ensure that it meets its obligations or the payment to the vendors, suppliers as and when they fall due for payment. And in step 4, entity can necessarily take the cognizance of the events or the conditions that may adversely affect the analysis that the entity has done so far. So if we have a look at our existing scenario of company A, wherein the company incurs a penalty of rupees 150 crores, the entity may simplistically consider how much fund does the entity has currently, how much fund it requires to honor the future obligations, presuming hypothetically that the entity would have a 30 crore cash and bank balance, which it continues to maintain towards the end of July, August, and it requires the additional cash requirement of 150 crores. The entity may simplistically say that it has an additional fund requirement of around 120 crores. If management is able to make an arrangement for the excess funds in order to honor the obligation, the material uncertainty cast by the payment of penalty or incurrence of the penalty may get or may stand eliminated to an extent. The management's plans to support the entity intended towards elimination of the going concern uncertainty are commonly known as mitigating factors. The mitigating factors stems out of the management's plans, and they are basically the management's strategies which are pointed towards eliminating either partially or completely the uncertainties around the going concern assumption. The management will need to assess the mitigating effects of the plans in terms of what is the expected time of implementing the plan and demonstrate how the plan would mitigate the liquidity requirement, short-term fund requirement, long-term fund requirement, and likes of those. Some of the mitigating plans may include raising an additional equity, external financial supports through borrowings, restructuring of the debt, cost reduction measures that the management may undertake, disposing of the assets or a business line. What is important that the mitigating factors eliminates the going concern uncertainty is that the plans must be feasible, they are capable of being implemented, and their implementation is probable. Having said so, I've tried to capture what steps that the management needs to follow in form of a very quick snapshot. So the management's assessment begins with identifying the events or conditions that may jeopardize the going concern position of the entity. After evaluation, if management reach a conclusion that these events, either individually or put together, does not cast any doubt on the entity's capability to continue as a going concern, then the management will have to ensure appropriate disclosures in the financial statement if required. After identification of the significant events conditions, management is of an opinion that they still cast the significant doubt on the entity's ability to continue as a going concern. The management needs to assess the material uncertainty. While assessing the material uncertainty, management, as we discussed, should also consider the impact of the mitigating factor. If material uncertainty does not exist, the going concern assumption gets fulfilled. The impact of mitigating factor could be positive or could be negative. Depending upon the scenario, the adequate disclosures will need to be made in the financial statements. This was a very quick snapshot as to how the management should conduct its assessment. Coming to the auditor's responsibilities of performing an evaluation, the performing performance of additional audit procedures cannot be completely ruled out. The additional procedures may take several forms. They could be either evidence based, they could be analysis based or inquiry based. What is meant by evidence based additional procedures? The auditor may consider reading minutes of the important meetings of the shareholders or audit committee, wherein there could be the traces or the discussions of the going concern assumption. Reading of the loan agreement, understanding the repayment period, understanding the future obligation, loan covenants, compliance with them may also provide material piece of information for the auditor's analysis and evaluation. Notices from the regulatory authority, analyzing the key financial ratio, analyzing the cash flows, comparing the prospective financial information's management forecast with the YTD financial statement could also serve as an additional source of information. Sorry. Inquiries with the legal counsel regarding the claims or regarding any other matter that may result in the nature of litigation that may result into the significant cash outflow, management's future plans would certainly provide a very important information that goes into the analysis of going concern. Specific considerations will necessarily have to be given to the management's plans, management's forecast, how the management has undertaken the cash flow budgets or cash flow forecast, how the management has collected the underlying data, whether it is reliable, whether there have been adequate reasons for the assumptions that management may make while estimating the future cash flows, whether any financial support is available from third party. Written representations, confirmations are some of the specific audit procedures that the auditor may consider. Just to give a brief idea as to what the additional audit procedures really culminate into, have taken an illustration of management's plan to increase the equity. When it is a scenario where increase in equity is proposed, and in order to ensure whether this proposal of the management is feasible, capable of being implemented, and whether it really eliminates the going concern related uncertainty, the audit procedures may include, first of all, the feasibility of the plan of stock issuance, the timing of the plan issue, whether the monies out of the issues are going to get collected within a foreseeable future, or there may be a situation wherein various regulatory approvals may take some time and the actual timing of collection of money out of the fresh issue may get extended beyond a period of 12 months. What are going to be the effects of increased equity, how the management is going to utilize these funds, availability of the authorized share capital, approval requirements with respect to the shareholders, regulatory approval, and whether at an overall level any uncertainty exists that may serve as an obstacle from increasing the equity share capital. All of us would have also heard or would have also gathered the audit evidences in terms of the support letter from the promoters, owners, or in case of the corporates from the holding companies or the ultimate holding company. Now, this becomes very critical to evaluate whether an entity or a person who provides a support letter or a letter of comfort is really in a position to extend that support unconditionally as and when that support is called for. It may not so happen that the support letter is mere a formality to eliminate the going concern assumption, and therefore the steps to be followed essentially include assessment of the ability of the corporate or an entity or a person providing the support, whether he really has the ability to provide such financial support. This could be evident on the basis of the financial statement, or in case of an individual or promoter, on the basis of the returns filed with the various authorities declaring the income. We may also assess the financial position and the commitments that the support letter provider has undertaken to assess whether he will be realistically in a position to meet the commitment. While the provider of this support may have enough reserves at his disposal, we may also see whether those reserves has already been committed to various other subsidiaries. In a similar manner, the support letter is given to our auditee client. Support taking the support letter while could be one of the convenient way of eliminating the going concern uncertainties, but it brings with itself various questions wherein auditor will have to get himself herself satisfied as to whether this support letter is really going to work. Consideration for the smaller entities, that is to say the small and medium sized entities, could be different. The smaller entities may get quickly affected by the going concern uncertainties. They could be even more vulnerable to the uncertainties with respect to the going concern assumption. The information with respect to the smaller entities could be gathered in form of the available sources of finances, the possible loss of the principal supplier, customer, key employees, what are the rights and obligations that the smaller entity has in terms of its day-to-day obligations. In many cases, as far as the smaller entities are concerned, the management might not have conducted a formal or an elaborated analysis of the going concern. Instead, because the management is closely connected with the day-to-day business activity, they may rely on the depth of the business knowledge and anticipated future plans. Nevertheless, in this situation also, while the auditor may not rectify the lack of going concern analysis, auditor will certainly need to evaluate the assessment. In this situation, it may be appropriate for the auditor, as a part of the audit procedure, to hold the discussions with the management to ascertain the short-term, medium-term, long-term plans that the management may have. The auditor may also ascertain the extended assessment by the management in case the discussions with the management do not turn out to be satisfactory or do not completely provide the evidence so as to firmly assert the going concern status. Continued support from the owner manager is quite common in case of the smaller entities which are promoter driven. In this case also, the additional procedures that we have seen will need to be performed. Considering our earlier example, company A and company B, for to facilitate the ease of understanding of the going concern assumption and the implication, let's extend that example. Now, having understood how the management evaluates the going concern, having understood how auditor is supposed to evaluate the going concern assumption, perform the audit procedure, corroborate the same with the various evidences that have become available, assessment of the mitigating plans of the management, let's have a look at this scenario. Company B, which was initially we have seen with a negative net worth and the current liabilities exceeding the current assessment, is now in a position to get unconditional financial support from the promoters. Based on this unconditional financial support, the company is now in a position to meet their obligation as and when they fall due for its repayment. The auditors are also satisfied, based on the additional procedures performed, that the promoters are in a position to honor their commitment by extending the financial support. Now, what would be the going concern assessment and going concern conclusion in this scenario? Can't we say that the going concern assumption in this scenario is appropriate because of the mitigating factors that exist in terms of the unconditional financial supports provided by the promoters? And thus, if company B is able to get the unconditional financial support, we can easily say that the going concern assumption may turn out to be appropriate. Depending upon company B's performance post balance sheet date, the way it is able to manage the working capital requirements, the way it is able to utilize the additional financial support that has become available from the promoter, assessment will need to be done. While the going concern assumption happens to be appropriate, is there any kind of uncertainty that still continue to exist? In exactly a contrary situation, let's have a look at company B again with negative net worth and unfavorable working capital scenario. The company B is not able to have any alternate plans, nor company is able to raise the additional funds as the financial position gets further deteriorated post balance sheet date. Would we be right in saying that the going concern assumption continues to hold good and appropriate in this scenario? Think for a moment, then we will see the conclusion. Because the company is not able to have the alternate plans and the situation gets worsened, may certainly impose the financial or liquidity crunch over the company, and therefore the going concern assumption may not be appropriate in this scenario. We have now seen when we can say the going concern assumption is appropriate, why it is appropriate. If going concern assumption is not appropriate and why it is not appropriate, let us have a consideration or an understanding as to how accounting is done, how the disclosures are handled, and what is the overall implication that the accounting consideration and the disclosure requirements have over the audit reporting. Accounting considerations fairly simple. Going concern basis conclusion by management, when it appears to be appropriate, the financial statements would be prepared on as is basis as they have been prepared historically with consistent application of the accounting policies. Going concern assumption appears to be appropriate, however, material uncertainties exist. In our example, company B is able to generate or get the additional support in terms of the promoter's commitment to provide additional finances. However, conditions getting worsened post balance sheet date, though the additional support exists, there may be some certainties with respect to the going concern assumption. This does not mean that the going concern assumption is not appropriate. In this scenario as well, we will have the financial statements prepared as they were being prepared in past with the application of the consistent accounting policies. Now, how the accounting happens to be different when going concern assumption turns out to be inappropriate. So when the going concern assumption turns out to be inappropriate, the company will not be able to continue in foreseeable future. Company will not be able to realize the assets at the value at which they are stated in the financials. The company will not be able to honor its obligations. Company will not be able to make payment to the vendors, suppliers, creditors, employees, as and when they fall due for its payment. And hence, the accounting literature requires the financial statement to be prepared on liquidation basis of accounting. The liquidation basis of accounting means that the assets and liabilities are adjusted to reflect a value at which the assets will be realized and the value at which the liabilities would get settled within the foreseeable future. So, if going concern assumption is not assessed appropriately, it may result into incorrect application of the basis of accounting, incorrect preparation of the financial statement, and the financial statement in the absence of correct or desired application of the accounting policy may by themselves would result into a material misstatement. The material misstatement that may happen on account of inappropriate application of going concern assumption could be at times pervasive because it may touch individual line item, individual component that the financial statement has. So instead of preparing the financial statements at the realizable value or on a liquidation basis of accounting, if they are still stated at an historical cost, the implications of the material misstatement could be large. I just thought of making this point at this stage because it would be completely relevant when we are going to see the repercussions of these misstatements in the audit report. Disclosure requirements are fairly simple. Going concern basis conclusion by the management when considered either appropriate or inappropriate may not necessarily result into the disclosures. Events and the conditions that management identifies as to casting significant doubt on the going concern assumption, whether they affect the going concern assumption or not, a disclosure would necessarily be required in the financial statements. Next comes the very important piece of auditing, that is the implications of the going concern on the audit report. We will also have to touch upon the principles established by SA 700 or a series of SA 700 while concluding what sort of implications going concern assumption or non-going concern assumption would have on the financial statement. Now let's look at a scenario whether when going concern assumption happens to be inappropriate. Management is of a view that the going concern assumption is appropriate. The auditor is of a view that the going concern assumption considered by management is inappropriate. As I covered in my earlier discussions, the financial statements could be materially misstated, where the organization or an entity does not happen to be a going concern entity, but it is shown as a going concern entity, will lead to inappropriate application of accounting policies. The financial statement may not necessarily be stated at the net realizable value. Statement of the financials at the net realizable value would touch each and every component of the financials, and therefore the misstatement would be pervasive. If we touch upon the guidance provided by SA 700 series, where the misstatement happens to be material and pervasive, it is necessary to express an adverse opinion, and hence the situation where inappropriate going concern assumption held by the management would lead to the adverse opinion scenarios. Let's have a look at another situation. The management's conclusion of non-going concern basis happens to be appropriate. So management and the auditor are on the same page and they have concluded that the preparation of the financial statements on a non-going concern basis or on a liquidation basis happens to be appropriate. In this situation, the financial statements gets prepared on a liquidation basis. The management also makes the adequate disclosure in the financial statements as to the basis of preparation that the entity is no more a going concern entity. Before I go to the solution directly or conclusion directly, let's gather our thoughts as to what could be the possible repercussions of this particular scenario over the audit report. Okay, I'm sure that while all of you would have gathered the thought, some of you might think that when the adequate disclosure is made in the financial statements and management and the auditors have concluded in a similar way as far as going concern assumption is concerned, it may not require any additional remark or it may not require a modification in the audit report. However, it may not be so. The going concern assumption is so fundamental to the preparation and presentation of the financial statement. It is so much so an integral part of the financial statements that there may be a necessity to bring out the fact that the entity is no more a going concern to the readers as well as the users of the financial statements. And hence, in this situation, the auditors will require to report this by way of an emphasis of matter paragraph in the audit report. As we all are aware that the EOM paragraph in the auditor's report is not a qualification. However, the matters which we are going to report under EOM are of such an importance or are such a fundamental matters that we need to bring the notice of such matters to the user's understanding. And hence, in this situation, the emphasis of matter paragraph is very much needed. Let's have a look at one more scenario. We have tried to cover all possible scenarios, all possible permutation and combination for the ease of understanding of the going concern evaluation. The next scenario, going concern assumption is appropriate. However, there exists material uncertainty as we have seen in case of company B. The management has made adequate disclosures in the financial statement. So going concern assumption is appropriate. There is also an adequate disclosure in the financial statement. So now what would be the implications on the audit report? Whether there shouldn't be any remark in the audit report, whether it is an EOM, because as I said, that the going concern assumption is so fundamental that although all the checklist or all the boxes are tick mark, it may still need to be intimated to the users of the financial statement. Let's gather our thought for a moment and then we will see the conclusion. Okay. Few of you might have thought that this may not require any disclosure or this may not have any implication in the audit report. Few of you might have thought about the emphasis of matter. However, the situation gets rightly addressed under SA 570 revised. The SA 570 comes up with a specific requirement to include a paragraph that is titled as Material Uncertainty related to going concern in the auditor's report. So, in a situation like this, where the going concern assumption is appropriate, however, some amount of or some element of material uncertainty exists, and when the adequate disclosure is made in the financial statement, the auditor is still required to bring to the notice of the users of the financial statements the fact of having said materiality being into existence and how the going concern assumption is considered appropriate. Please note that the requirement to include a paragraph on MUCG, that is material uncertainty related to going concern, is not a substitute for EOM. Neither emphasis of matter is considered to be a substitute for MUGC. This is a completely different requirement which has been put across by SA 570. When MUGC paragraph is given in the auditor's report, there is no need to again give a separate paragraph by way of emphasis of matter. Let's have a look at the one more scenario. Going concern assumption is appropriate, material uncertainty exists, and a situation where either no disclosure is made in the financial statement or inadequate disclosure is made in the financial statement. We have seen all possible scenarios so far. So let us try to understand and evaluate this scenario as well. Let us take a pause here to gather our thoughts as to what would be the conclusion by the auditor before he actually signs off the report. Let's assemble back. A situation of no disclosure or inadequate disclosure results into escaping material piece of information from the users of the financial statement. And because either when there is no disclosure, absence of disclosure, or inadequate disclosure is made, it may have or it may result into misreading of the financial statements of the company. Misreading of the financial statement by the users of the financial statement may result into implied misstatement. Depending upon what are the inadequacies in the disclosures made by the management, whether critical piece is being absent in the disclosures made or when there is absolutely no disclosure, the auditor will need to form an opinion whether inadequate or no disclosure results into material misstatement or they results into material as well as pervasive misstatement. The auditor's conclusion in this scenario would differ from the situation to situation, circumstances to circumstances, and would largely be driven by the facts of the individual case. And accordingly, the auditor may express either a qualified opinion or an adverse opinion in this particular case. We have seen emphasis of matter. We have seen material uncertainty paragraph related to going concern. We have seen appropriate consideration of going concern and its implication on the audit report. We have seen the instances where the qualified or an adverse opinion may get triggered. Over and above all this, there is an overarching reporting requirement which may otherwise not come into picture if everything goes well. That requirement is specified and prescribed under Section 143(3)(f) of the Companies Act. So if you recollect the format of the audit report, the main audit report wherein we try to cover the clauses A, B, C, D, E, F, G, the clause F requires the auditor to report upon the observation or the comments of the auditors on the financial transactions or the matters that may have any adverse effect on the functioning of the company. The matter or the transaction that may have an adverse effect on the functioning of the company, the determination as to what is an adverse effect is itself a matter of a professional judgment. The literature does not define what are the financial transaction or matter that may have an adverse effect, or when do we consider a particular transaction having an adverse effect, or what is meant by the adverse effect by itself. ICAI has provided an elaborative guidance on this in terms of guidance note on section 143(3)(f) and G, and the critical factors that need to be considered while reporting under this clause: the significance of the matter, how pervasive is the matter. So, how pervasive is the matter that requires a reporting under section 143(3)(f)? What is a magnitude of the matter that would require a reporting here? So again, if we try to correlate this particular reporting requirement with our situation of company A and company B. So in case of company A major catastrophic event of incurrence of a penalty, which is almost equal to net worth of the company, may find its place while reporting under section 143(3)(f). Similarly, when the adequate disclosures or is not made in the financial statements with respect to the appropriateness of the going concern assumption, or where the situation of company B gets worsened after the balance sheet date, the company is not able to raise the additional funds. The company is not able to seek the additional financial support in the market. The matter may become so pervasive that it may affect individual component of the financial statement, and such scenario, such material uncertainty may lead to or may happen to be a catastrophic uncertainty and may find its place of reporting under section 143(3)(f). So whenever an assessment of going concern takes place and the conclusion that we reach is either inappropriateness of going concern assumption or appropriateness of the going concern assumption coupled with material uncertainty, the auditor has to analyze the reporting implications under section 143(3)(f). Now, in again continuing the same example of company B, company A, just to facilitate the ease of understanding, and we have a granular understanding as to how the reporting needs to be concluded. Company B, again with negative net worth, current liability exceeding current asset, the promoters provide unconditional support, are in a position to meet the obligation. Going concern assumption appropriate and material uncertainty exist. What would be your take as to the implications in the audit report? Let's gather our thoughts for a moment. I'm sure at this stage all of you would have gathered it right. If adequate disclosure is made, then we will provide a paragraph on MUGC, material uncertainty related to going concern, and in the absence of inadequate disclosure or no disclosure, it may result into qualification or an adverse report. Same example, I thought of continuing with the same example so that we catch a thread of going concern, catch a pulse of a going concern, and learn this concept at a granular level. Same company B, the company has no alternate plans to raise the fund. Going concern assumption may not be appropriate. And what would be the repercussion of this on the audit report? If the financial statements are prepared on a going concern basis, it may result into material misstatement and therefore an adverse opinion. Else, with adequate disclosure, we may simply provide the emphasis of matter. I have tried to cover the auditor's responsibility by way of a quick snapshot. So the auditor's evaluation goes in this way. When the going concern basis of accounting is appropriate, auditor will need to evaluate whether there exists material uncertainty and when there do not exist material uncertainty. Material uncertainty existence would depend upon the additional procedures performed, the additional plans by the management, mitigating factors that the management may resort to. If material uncertainty does not exist, auditor may simply evaluate whether there is a need to give the disclosures and whether such disclosures are as required. If material uncertainty exists, auditor will further need to evaluate adequate disclosure is made in the financial statements. If adequate disclosure is made in the financial statement, highlight the material uncertainty and include a para on MUGC. In case of the inadequate disclosure or no disclosure, when going concern assumption happens to be appropriate, he may simply express a qualified or an adverse opinion. Where the going concern assumption does not happen to be appropriate, the management and the auditors are in disagreement. The auditor may express an adverse opinion. So in a summary, this is how the going concern assumption evaluation would culminate into the conclusion and the repercussions over the audit report. Let us have a look at some of the case studies and the practical scenario where we can apply the key takeaways from the discussions that we have had so far. I have put a case study on the screen. We may take a while to read the case study and also analyze the implications of a given situation on the audit report. We may take few minutes to read this and few minutes to prepare our conclusion on the case study. The case study has little long description and the conclusion needs to be built under two different scenarios. So I'm just extending couple of more minutes and then we will start discussing the case study. Okay, so let's come back. I'm sure that by this all of you would have assembled your thought and would already have reached a conclusion. So let's have a look at a case study, and while reading the case study we will discuss the significant aspect and the conclusion. Sunshine Limited is a client with considerable cash flow difficulties. Other less significant operational indicators of going concern problems. Sunshine Limited is currently trying to raise finances to fund operating cash flows and state that if the finance is not received, there is a significant doubt over the going concern status of the company. So the first paragraph already shows the difficulties faced by Sunshine Limited. It is into a distress situation and which is a trigger point of going concern. As a matter of mitigating factors and the management plans, the management is trying to raise the additional sources of the funds. The working papers conclude that the going concern basis of accounting is appropriate. However, it is recommended that the financial statements should contain a note explaining the cash flow problems faced by the company, along with a description of the finances being sought and an evaluation of the going concern status by the company. So there has been the ask by the auditor, while the going concern assumption appears to be appropriate, there should be an adequate disclosure of the current problems faced by the company, the mitigating plans by the company, and the overall evaluation of the going concern status of the company. There could be two scenarios in this case wherein we have to develop a solution. The director refused to provide the disclosure note and the director agrees to give the disclosure note. Now let us see how we build up a solution. In first scenario, when the directors refuse to give a note, in the absence of adequate disclosure, we go back to the basic principles that we just saw a while ago. Because of the inadequate disclosure, the auditor report should contain a qualified opinion or an adverse opinion due to the disagreement as to the inclusion of the note. The auditor may also need to make a decision as to the significance of the non-disclosure of the uncertainty surrounding going concern basis of accounting. If it is decided that without the note, the financial statements are not fairly presented and could be considered misleading, an adverse opinion should be expressed. So, all in all, in the absence of the relevant disclosures in the financial statement, the auditor will have either a qualified or an adverse opinion. Now, what happens when the directors agree to give a disclosure note? First of all, only inclusion of a note is not enough. The auditor will need to review the note and need to ensure that or need to assess that the note has all relevant details into it. So as the auditors have suggested that the note should explain the cash flow problems faced by the company along with a descriptive note on the finances being sought and an overall evaluation of the going concern are the components that really need to form a part of a note. The note should include the description of the conditions giving rise to the significant doubt and the director's plans. This is precisely what we discussed. Having considered and understood that the directors have given the adequate note, the auditors shall include a paragraph on MUGC, material uncertainty related to the going concern in the audit report. This is precisely consistent with the illustrations examples we saw a while ago. There could be a third situation where the note has been given and the details are inadequate, do not fully explain the significant uncertainties, which is the crux of the whole matter of the going concern status. The auditor may again express the qualified and an adverse opinion. Let's move on to the next case study and let's try building up the solution for this. We'll wait for a few minutes and then we will discuss the solution. Coming back to the case study, let us read it out very quickly to analyze. XYZ Inc. is a manufacturer of televisions. The domestic market for electronic goods currently not doing well, and therefore many entities in this business are switching to export. The domestic market for electronic good is currently not doing well is one of the adverse conditions that would trigger the going concern assumption and the uncertainty around it. As per the audited financial statements for the year ended March 31, the entity had net loss of rupees 120 millions. As at March 31, the current assets aggregate to 1200 million and current liabilities aggregate to 1500 million. Current liabilities exceeding the current asset is another trigger point showing the uncertainties towards the going concern assumption. Due to the expected favorable change in the government policies for the electronic industry, the entity is projecting the profits in the coming years. Furthermore, the shareholders of the entity have arranged additional sources of finance for the expansion plans and support the working capital requirements in next 12 months. Favorable changes in the government policy for the electronic industry is an external mitigating factor that will work in favor of the entity. Shareholders of the entity arranging the alternate source of the finance for the expansion plans and the working capital requirement is another mitigating plan or the management plan to support the financial requirements of the company. As we have seen, the favorable change in the policy and the management plans of providing additional support would require the additional audit procedures by the auditor to ensure that the plans of the managements are workable and they are eliminating the distress situation and provide support to the entity. Now, the issue that we need to deal with, should INC prepare the financial statements under the going concern basis of accounting, considering the management's assessment for the next 12 months? Let's go to the solution. As we discussed, the two factors that raise the doubt on the ability to continue as a going concern are the net loss during the year and the working capital deficiency. At the same time, there exist two mitigating factors: the arrangement made by the stakeholders expansion, projected future profitability due to expected favorable changes in the government policy for the industry that the entity is operating. Based on this set of the facts, the management may argue that the going concern assumption is appropriate. However, at the same time, the management will need to put pen to paper, provide all the calculations, all the necessary projections, all the necessary forecast to the auditor as to how the government policies and the stakeholders plan to fund the expansion would eliminate the going concern uncertainties. So based on the evidences that the management provides to the auditor, if auditor is able to conclude on the basis of the evidences that there is a reasonability of the future profitability and no material uncertainty exists in relation to the going concern for the next 12 months, the auditor may simply say that the material uncertainties surrounding the going concern do not exist anymore, and therefore there may not be any repercussions at all on the audit report. At the same time, just to give the readers of the financial statement about a complete piece of information, a suitable disclosure may be made in the financial statements. Let's have a look at the next case study. We'll wait for a few more minutes. I'll give you a couple of minutes to think and build up a solution to this particular case study. Okay, let's gather back. ABC Limited is a company which is into manufacturing of yarn with two working directors on the board, each holding 50% equity. The company was incorporated 5 years back. There was a dispute among directors due to which both directors filed for liquidation of the company. So this shows that the company is in the process of being liquidated, and thus the company may not be able to operate for a foreseeable future. The company has sufficient assets, including movable and immovable. The company has sufficient assets, including movable and immovable assets, to pay off the liabilities of the company. Though the company has sufficient funds to honor its obligation, the overarching fact remains that the directors have filed for the liquidation of the company, and the company may get shut or wound up at any point of time. Liquidation process is at initial stage. What disclosures are required in the financial statements and the audit report of the company? Let's have a look at the situation. In the present scenario, the company has initiated the liquidation process. The moment the liquidation process gets started, though the company had sufficient funds at its disposal, the overarching fact of the liquidation process makes the company no longer a going concern entity. In this situation, when the company is not a going concern entity, the financial statements will need to be prepared on a liquidation basis. So to say, the asset and liabilities will need to be stated at a realizable value. In this situation, when the financial statements are prepared under going concern basis, we have seen the auditor will need to express the adverse opinion. In case the financials are prepared on a liquidation basis and the auditor determines that such alternative basis is an acceptable framework, the auditor may express an unmodified opinion. Unmodified opinion would be warranted only when there is an adequate disclosure about the basis of preparation in the financials. However, the matter is of such a magnitude that it would require bringing the fact to the notice of the readers of the financial statements by way of inclusion of emphasis of matter paragraph in the audit report. This is absolutely consistent with what the principles what we discussed few minutes ago. Let's have a look at the next case study. I'll wait for a couple of minutes to build up the solution. Okay, let's come back to the case study. A company is an exclusive seller in the country for retail sale of imported branded garments and was set up 2 years ago, having share capital of rupees 1 lakh and unsecured loan of rupees 200 lakhs and has accumulated losses of rupees 50 lakhs. The fact shows that the company is into initial or nascent stages of its operation, which is evident from the fact that the company was set up nearly 2 years ago. The company has a very lean structure in terms of equity with equity capital of only rupees 1 lakh, which shows that in case of any liquidity crunch, the equity may not be of any help. The company is highly geared by way of unsecured loans of rupees 200 lakhs. To add to the situation, the company has accumulated losses of 50 lakhs. Now, to salvage the situation, the loans have been granted by the promoters of the company along with the family members. The company has negative net worth, negative working capital, and the promoters have sufficient net worth. And to salvage the situation, they have plans to invest into the business in future. The question is, how should the auditor gather sufficient and appropriate audit evidences to conclude on the appropriateness of the going concern assumption? At the same time, what disclosures are necessary? Let us see the solution. The auditor should obtain and review the management assessment of the going concern basis of accounting, which would include cash flow projections, detailed business plan covering the period of assessment, which is foreseeable future 12 months, support for the entity's ability to obtain new funding. All these three factors put together would demonstrate as to how the liquidity crunch currently faced by the company would get resolved. The auditor may also consider obtaining a support letter from the promoter for the next at least 12 months. In case of support letter, the auditor should assess the intent and capability of the promoter to provide support. So this is precisely what we discussed when we were talking about the additional audit procedures. However, in the present circumstances, material uncertainty exists. Accordingly, the financial statement should include adequate disclosure, including availability of the financial support from the promoter. The auditor should report under a separate paragraph MUGC, provided that the adequate disclosures have been given in the financial statements. So with this, we end the case studies, and I hope that the case studies together with what discussions we have had earlier would enlighten you and would provide you with the enough insights as to how do we dissect the going concern, how do we gather additional evidences, and how do we reach a conclusion. Let us quickly have a look at the certain important FAQs that ICAI has issued. One of the important FAQs is what is the responsibility of the auditor if there is a significant delay in the approval of the financial statement. The significant delay in the approval of the financial statement by itself may not necessarily point out the uncertainties around the going concern. It may or it may not be. And therefore, as an auditor, as we discussed, that the auditor skepticism and the auditor to remain alert throughout the process of the audit, it becomes necessary for the auditor to inquire the reasons of the delays. Based on this inquiry, discussions with the management, if the auditor believes that the delay is on account of the events or condition that relates to the going concern assessment, then it becomes necessary for the auditor to perform the additional audit procedures, irrespective of the facts that the financial statements have already gone for the approval. Based on the auditor's assessment, evaluation, and the outcome of the additional procedure would decide the implications of the scenario on the overall audit report, whether it is a material uncertainty, whether it is EOM, whether it is MUGC, whether it is qualified opinion, or whether it is an adverse opinion. Another important FAQ relates to the CAM. All of us, we are aware that key audit matters now need to be included as a part of the audit report for the better understanding of the preparation, presentation, conclusions reached by the auditor. CAM, as per the guidance provided, and even if we try to apply the SA 570 practically, the CAMs should not be confused with the emphasis of matter paragraph or the paragraph in relation to the material uncertainty ongoing concern. In a case where the material uncertainty exists, the auditor has to fulfill the responsibilities in terms of either MUGC or EOM or qualified opinion or an adverse opinion, depending upon the facts of the case. Now, what really culminates into the key audit matter could be the factors that the auditor would have examined in the process of performing the additional procedure and reaching a conclusion as to the going concern. These matters could be the substantial operating losses, the existence of the operating losses, the existence of the borrowing facilities, possible debt refinancing, non-compliance with the loan agreement, or maybe certain other related mitigating factors. So all in all, CAM is neither a substitute as to the auditor's responsibilities in terms of the modified opinion in the audit report and vice versa. I hope that and I trust that you all would find this session useful, and I'm sure that the insights of this session you would definitely apply in the real life situation. Thank you so much for the patient listening.
Thank you so much, ma'am. It was wonderful. It was the wonderful presentation, and you have justified with your presentation and explained in a very lucid and explanative manner. And I have received certain questions from the members. If you allow, can I ask those questions?
Sure, sure.
Ma'am, first question is it is not going the company. Madam, there is a new guidance note on tax audit. New guidance note on financial statement is applicable or not for the corporate entities and how you relate with the going concern.
So the going concern itself is a literature or a theory by
Yes.
itself. Okay. So going concern is an overarching principle, and the assessment of the going concern needs to be done on a real life scenario basis. Auditor will need to assess a certain what is a matter that one needs to evaluate and one needs to reach a conclusion upon. So while there may be the additional guidances available, the going concern assessment has to happen by itself within itself and applying the principles what we spoke just now.
Yes, sir. Ma'am, another question is in concern and doubtful or not. Small companies nominal business transactions for 3 to 4 years, but management says have a business plan in future. So how to comment on this, ma'am?
Sir, can you please repeat the question? I wasn't able to hear it completely.
Uh, question is going concern is doubtful or not. In this particular case, member is asking going concern is doubtful or not. Small companies nominal business transactions for 3 to 4 years, but management says it has a business plan in future. Management is saying it has a business plan in future. That means they will survive for longer.
Understand.
Small companies like having the nominal business transactions for 3 to 4 years. So it is doubtful or not?
Right, right. So, definitely the consideration for the smaller companies could be slightly different without deviating from the basic and the core principles of the going concern assessment. Um, in case of the smaller companies, the management might not have a very formal and an elaborated plan or the assessment that would have been otherwise necessary. In case of the small company, the ecosystems would be different. The way the businesses are conducted would be different in a sense that the promoters, owners are closely related and they are into the thick and thin of every aspect of the business. So it would be necessary in case if there are trigger points that the smaller entities may not continue its business operation in a foreseeable future, the best way is to hold the discussions with the management, understand the management's short term plans, understand the management's medium term plans, and at the same time, the long term plans. It may so happen that the management may not necessarily have the long term plans and may be conducting the business on an as is basis. However, in this situation also, the auditor can corroborate the evidences in terms of the management's intention as to the continuity of business, the expansion plans, the subsequent status of the financial statements. The financial statements might not have been prepared in a much formal manner. However, I'm sure that there may be some amount of intelligence that would go around in obtaining this kind of this particular piece of information. Once we take the cognizance of all these facts put together, we should document that accordingly in our working paper. And I'm sure when the outcome of these additional procedures, whether in terms of the inquiry or whether otherwise, would definitely provide a basis or a good basis for conclusion of the going concern assumption.
Ole? Yes, madam. Ma'am, another question is relating to the new startup. One member is asking for a startup who is burning money every month. If it is in the position process of next round of funding, which is not certain, and the current cash balance is sufficient to manage next 6 months cash burn, how will the impact going concern disclosure?
Right. So the startup companies may also sell in a little different scenario. The startup companies, especially when they are in the nascent stages of the operation, the going concern analysis may become little judgmental or it may be even judgmental. At a times, it may turn out to be complex. So the question that member has asked, there are two aspects. One is how do we assess going concern for the startup company and whether a period of 6 months is good enough. So the answer to the second question, the law mandates the going concern assessment to be of 12 months. So we cannot afford to have this assessment for 6 months. We need to conduct it for 12 months. Any period of 12 months or more than 12 months is reasonable. 6 months period is short enough to comment on how the financial statements and business operations would shape up. Coming to the going concern assessment as far as the startup companies are concerned, the auditor again will need to perform the additional procedures if there are trigger events. So to say, the company may have the sufficient cash balances, the company may have sufficient funds to honor the obligation. However, as long as there is a trigger of the going concern assumption, the additional procedures in form of the plans of the management, the plans of the The overall business plans in terms of the expansion need to be considered. In this case, the future cash flow projections could play a significant role as to how the startup entities and the owners of the startup entities are going to see themselves in the market. The cash flow projections may also be analyzed to evaluate whether the assumptions on which the cash flow is based are appropriate, they happens to be reasonable. Not saying that the each and every move need to be questioned, but where the things are going to affect or the assumptions are going to affect the overall analysis would need to be definitely questioned for. Startup entities may also be given a consideration that they are into the nascent stages of the business, and accordingly the inquiries need to be structured. And I'm sure based on these additional procedures, the cash flow projections, definitely a direction would be received as to the entity is moving in a right direction, so as to say that it is a going concern.
Yes, sir. Ma'am, when the company has negative net worth and negative capital and negative cash flow, all the three things are negative: negative net worth, negative working capital, and negative cash flow for an unlisted company. How the audit report will be drafted? And second, disclosure is there in the notes, and the company will revise or close down business line in the next 12 months.
Okay.
So, what is your opinion and what is your expert advice in this case, ma'am?
Yeah. So negative net worth, negative working capital, and negative cash flow,
Cash
all
flow.
these, yeah, all these three things put together, these factors, when they are seen in the aggregate, clearly shows that the company is into a financial distress situation. The financially distressed company, for financially distressed company, the going concern assumption uncertainty is quite obvious. In this situation, certainly the assessment needs to happen for a period of 12 months. Additional procedures in terms of the inquiring with the management about the short-term plans, long-term plans, the future cash flow projections are going to be the important piece of the additional audit procedure. As long as the management is able to demonstrate that it will make the additional funds available to the company, or if management has some other alternate plans in place which is capable of being implemented, which is probable, and where there exists a probability that the plan may succeed and it will have a positive impact in terms of providing the cash flow support to the entity, the auditor will need to take the same into consideration after again performing the required procedures. The questioning mind of the auditor, the skepticism of the auditor, and the alertness of the auditor will definitely have a role to play here. When the situation is so grave as in a current situation, negative net worth, negative cash flow, negative working capital would certainly raise a doubt in case if the management is able to project the positive cash flow, that as to what is a fundamental behind projecting the positive cash flow. The auditor should also take into consideration that this is not a scenario at every year end. The note is not forming a part of the financial statement at every year end, which means that there is something really wrong in the functioning of the company. And in spite of the due efforts taken by the management, the situation is not completely getting revived, either partially or completely. In this situation, a mere representation by the management or a mere forecast by the management of the cash flow is definitely not going to serve a purpose. And hence, in this situation, the audit report may be more than merely an emphasis of matter that merely describes the existing uncertainties around the financial situation of the company or a going concern status of the company. This would be my overall take in this
Yes,
situation.
sir. Yes, sir. Yes, sir. Yes, sir. Ma'am, another question. When an entity has closed its business in the mid of the year, they have closed down their business in the mid of the year, but balances of fixed assets, debtors and credits are outstanding on 31st March. So how to deal with it when doing tax audit? Whether the fixed assets should be reduced to and be reduced from the block of assets.
So is this question more from the tax audit point of view?
It seems
We may deal with it offline, sir.
yes, yes, yes. We will. I will forward it to you. Then
Sure,
I'll get the response. Then I'll forward to the member.
sure.
One more question. It is relating to the when operations have been suspended for the last 3 years. Company hopes to revive once demand picks up. This may take another year also. This is a contingent or revival of demand. What should be decision on going concern assumption?
So if company had
Member
suspended
is
the
saying operations have been suspended for last 3 years. They have suspended. But
okay,
company hopes to revive once demand picks up.
okay.
And this may take another year too. So this is a contingent or revival of demand. What should be the decision on going concern assumption, madam?
Right. So the operations of the company have already been suspended and the company is non-functioning or a non-operating sort of a company. Company is not having any sort of business activities. So the company, ideally, if we apply the principles of the going concern, is not in a position or is not capable of being operated. The plans of the management of the revival
Yes, ma'am.
may turn out to be successful or they may even be unsuccessful. As an auditor, we cannot predict the outcome of the management's plan, right? So while reporting in the audit report or while concluding on the going concern assumption, the while we may take into consideration the management's plans, but having regard to the history for the last 3 years, this plan may not really help in reaching any conclusion. As long as the company is not undertaking any activity, and since the company is alive, I'm sure that there may be some kind of a support from the promoter or some kind of an external support just to meet the compliance cost of the company. In this scenario, it shows there is either a direct or indirect support to the company by the promoter, owner, and manager, and it would be advisable to take the commitment of this support in writing and state that though there are no operations currently, the company is planning to have a turnaround, demand revival, so and so, until the time the company is able to achieve. There is an ongoing support from the owner, promoter, director. If this support does not exist, the company may not happen to be a going concern. So all the facts, repercussions, everything will need to be taken into consideration. Appropriate note to be drafted in the financial statements. And when the adequate disclosure is given in the financial statement, we may either have the MUGC paragraph if we are convinced that there is an enough support, or otherwise it may lead to the other modifications in the audit report.
And one question is, while going through this going concern, adverse opinion is required. Yeah. Why adverse opinion? If that is fine, then why adverse opinion is necessary when financial statements are prepared on going concern basis?
So adverse opinion is required only in a specific situation. So as we have seen, various types of the opinion to start with emphasis of matter, which is just to bring the facts to the attention of the stakeholders. The paragraph in relation to the material uncertainty relating to going concern, which is again one of the way to describe the material uncertainty and yet asserting that the entity is a going concern. The third type we saw is a qualified audit report and the adverse audit report. So qualified and the adverse audit report have the typical characteristics and they can be used in a very specific situations. So if we go back to the series of SS 700, the qualified opinion is to be given when the misstatements are material. Adverse opinion needs to be given when the misstatements are material as well as they are pervasive. So now, before I answer this question, we will need to understand what is actually meant by pervasive. So a misstatement happens to be pervasive when it impacts most of the components which are provided in the financial statements. Okay, so when we, just to illustrate, when we say that the foreign currency debtor is not revalued as at the 31st March rate. So this misstatement, though material, it still touches only one component in the financial statements, that is trade receivable and the profit or loss for the year as the case may be. However, when we talk about the adverse opinion in the situation of a going concern, the adverse opinion arises only when the going concern assumption is inappropriate. So why do we say it would result into an adverse opinion? The inappropriateness of the going concern assumption immediately impact the application of the accounting policy. If entity is a going concern, we may prepare the financial statement on the as-is basis, the way we were preparing in the past under historical cost convention. If going concern assumption is not appropriate, there may be the application of liquidation basis of accounting. And when the going concern assumption is not appropriate, it may miss the liquidation basis of accounting, and liquidation basis of accounting may impact not only the significant items but almost all the components of the financial statement. And therefore, this misstatement is so grave that it will have more than the material impact, which in technical term is called as a pervasive impact, and therefore the adverse opinion is needed.
Yes, ma'am. Yes, ma'am. Thank you so much, ma'am. You have covered a little bit part of liquidation base also. One query was relating to the, one member was asking to kindly throw light on liquidation basis of accounting also. So you have covered this thing also. If you would like to throw more light on liquidation basis of accounting while comparing or correlating with this going concern, you may also, madam, please.
Sure. So liquidation basis of accounting is in a common parlance, the accounting for impairment. We all may be aware that we have the accounting standard on impairment that throws light, on the fact that as and when the assets do not fetch the value at which they are stated in the financials, the impairment assessment becomes necessary. And if there is a trigger of an impairment, it needs to be done. The same principle applies to the liquidation basis of accounting. Because the entity is not going to be an operational entity, it would sooner or later stop down the operations. It will not be able to fetch the value to the assets at which they are really stated in the financials. And therefore, there is a necessity to bring all these items of the asset to their net realizable value, the value they will fetch in the market, and state the liability at the best estimate of the management at which these liabilities would be settled. So if we see the fundamental assumption, the way we have going concern as a fundamental assumption, the principle of conservatism, that plays a big role when we prepare the financials on a liquidation basis to state the assets at realizable value and to state the liabilities at the best possible values at which they are going to get settled and account for the losses accordingly. So it is basically the exit value of the business or the asset that we are talking about.
Yes, ma'am. Yes, ma'am. So it was a wonderful deliberation, man. We have come to the end of today's webinar, and thoroughly speaking, complete 2 hours you have been speaking, and you have covered all the things relating to the going concern and answered so many queries also. So on behalf of AASG of ICI, I extend my heartiest thanks towards you, ma'am, for sparing your valuable time and full deliberation, ma'am. And
Thank
if
you
it
so
would be
much.
possible, ma'am, kindly share the presentation we will share with the members. And
Sure.
yes, ma'am. Yes, ma'am. Yes, ma'am.
Sure.
So
Thank you
once
so
again, thank you
much.
so much, ma'am. Thank you
Yeah.
so much, ma'am.
Thank you so much for giving me also an opportunity to present and meet so many members today. Thank you so much.
Thank you so much. Thank you so much. Namaste. Namaste.